All right, let's get right into it. For years, some of the biggest banks in the world were telling anyone who would listen that silver was a terrible investment. But as it turns out, behind the scenes, something totally different was going on. A story of a massive, really calculated buying spree. So in this explainer, we're going to break down exactly how it happened, why it happened, and maybe most importantly, what it means for you right now.
Right off the bat, the source material we're looking at here, it does not pull any punches. It doesn't frame this as just some smart market play. Oh no, it calls it a deliberate, long-term scheme. I mean, this one quote really sets the stage for a story of, well, deception and absolutely huge profits.
So just how big are we talking? Well, by 2020, JP Morgan had apparently piled up over 1 billion ounces of physical silver. A billion! To put that in perspective, that's more than most countries hold in their national reserves. We're talking about a private hoard of historic proportions. And the value of that hoard? The source material puts it at a staggering $58 billion. $58 billion. I mean, the financial stakes here are just almost hard to wrap your head around. And this, right here, this is the central question of the entire story. It's this massive contradiction that just doesn't add up. Why would a huge institution publicly trash talk an asset, while in private they're acquiring a world-changing amount of it? This is the puzzle we're going to start piecing together right now. So to understand the whole strategy, we've got to look at the mechanics first. How was it even possible to buy up so much so quietly? Well, the first piece of the answer, according to the source, is that they had to keep the price down. Let's just rewind the clock to 2011 for a second. After the big financial crisis, people were rushing into hard assets, things you can actually hold. And silver, well, it went on a tear. It skyrocketed from 14 bucks an ounce to nearly 50. And then bam! In just a few days, it crashed 35%. And the weird thing, there was no major news, no fundamental reason for such a violent collapse. So what gives? What triggered it? It turns out the COMEX exchange, where silver futures are traded, jacked up margin requirements 5 times in just 8 days. Now, in simple terms, that means traders suddenly had to put up way more cash just to hold their positions. A lot of them couldn't, so they were forced to sell, which started this domino effect that just cratered the price. And while all the small-time investors were getting wiped out, the banks, they started to buy. And the source alleges there was another tool in the toolbox they used to push prices down, an illegal trading practice called spoofing. It's kind of like this. Traders place these huge, fake orders they have no intention of actually filling. It creates a false picture of supply and demand, and that tricks other traders and algorithms into selling, pushing the price exactly where they want it to go. Now, this isn't just some wild conspiracy theory. In 2020, the Department of Justice itself confirmed it. They hit JP Morgan with a record-breaking $920 million fine for doing exactly this, for manipulating precious metals markets for years. Okay, but here's where you have to look closer. A $920 million fine? That sounds massive, right? But our source material estimates the profit on their silver position was over $38 billion. That means the fine was less than 2.5% of the haul. The analysis calls it not a punishment, but a licensing fee to cheat. Just a cost of doing business. So we've looked at the how, but why silver? I mean, why go to all this trouble for this one specific metal? The argument presented is that the answer is all in silver's unique and really powerful fundamentals. See, unlike gold, which is mostly just a monetary asset, store of value, silver plays this critical dual role. Yeah, it's been money for thousands of years, but it's also an absolutely irreplaceable part of modern technology. And this dual nature, this is the key to the whole thesis. And this chart just lays it out perfectly. Over half of all silver demand comes from industry. And here's the crucial part. That industrial demand is mostly inelastic. That means if you're building a solar panel, you need silver. It doesn't matter what the price is. There's just no substitute. And where is this demand coming from? Well, it's coming from the biggest technological shifts of our lifetime. Solar panels, electric vehicles, 5G, AI data centers. They're all creating this massive exponential demand curve for physical silver. This isn't speculation, it's structural demand. Okay, so you have this exploding demand on one side. What about the supply? Well, this chart shows the problem pretty clearly. The world is using about 200 million more ounces of silver every single year than is being pulled out of the ground. That deficit has to be filled from somewhere, right? It comes from above-ground stockpiles, which are not in.
And you might think, well, can't miners just dig up more? It's not that simple. See, about 70% of silver isn't mined on its own. It actually comes out of the ground as a byproduct when you're mining for things like copper, lead, and zinc. So the supply of silver is tied to the economics of totally different metals. You can't just flip a more silver switch. It's incredibly inelastic. So this brings us right to the heart of the whole alleged deception. The banks knew this supply and demand situation inside and out. So the argument goes, while they were busy buying it all up, they needed to make absolutely sure nobody else was. And here it is, laid out side by side, the actions versus the words. On one hand, their trading desks were quietly taking physical delivery of tons and tons of metal. And on the other hand, their research departments were publishing reports telling their own clients and the public to stay away. This quote from this source really it hits the nail on the head. It captures the essence of the whole strategy. By controlling the public story, they effectively scared off the competition, regular investors, pension funds, which let them accumulate their massive position at artificially low prices. So fast forward, after a decade of careful planning and buying, we've arrived at today. The long game, according to this analysis, is now finally playing out, and we're all starting to see the consequences. So here it is, the entire alleged playbook laid out step by step. Step 1, suppress the price using paper market games. Step 2, control the narrative to keep everyone else out of the market. Step 3, use that opportunity to buy up the physical stuff on the cheap. And finally, step 4, just sit back and wait for the reality of the supply crisis to inevitably take over. So for everyone who listened to the banks back then, what did they actually miss out on? Well, between 2008 and 2025, silver's return was actually pretty similar to the S&P 500. But, and this is a huge but, one of those is a paper asset that requires you to trust the system, while the other is a real physical asset you can hold in your hand, totally outside that system. A comparable return, but with a completely different risk profile. If there's one big lesson to take away from this whole story, the source material argues it's this. Always be a little skeptical of what the big institutions are telling you. The real truth isn't in what they say, it's in what they do with their own money. And that leaves us right here, right now. According to this story, the insiders got themselves ready years ago for the exact supply crisis that we are now entering. They bought at the bottom while telling everyone else the asset was worthless. So as the price finally starts to reflect reality, the question on the screen really says it all. Now what?